Hello friends, James Stephenson here, back with part 2 in a series on my latest Twitter earnings forecast. So, a couple of questions people wonder about. How profitable is Tesla? Are they going to become more profitable over time? What are regulatory credits? How do those work? Is Tesla only profitable because of regulatory credits? If Tesla is going to get more profitable over time, how will that happen? These are all the questions I'll dive into in part 2 of my forecast thread review. So let me share with you my desktop here, and I will bring up Twitter. The link to this thread will be in the video description below, so you don't have to go hunting for it. But in my first video, I covered tweets 1, 2, 3, and 4. So let's jump right to tweet number 5, and I'll cover tweets 5 through 10 in this video. How's that sound? This tweet, number 5, is showing Tesla's adjusted EBITDA, which is a profitability metric. It excludes the non-cash stock compensation and other things that are beyond management control, or they're not related to what the performance from that quarter was for the business. So things like depreciation on existing assets, how much you have to pay in taxes, those are not controlled by the people running the company. So that's what the adjusted EBITDA metric gives you. If we look at this chart, we can see where Tesla has grown to just a little over $4 billion in the most recent quarter of adjusted EBITDA. That was a record high, and I'm forecasting that every future quarter will be significantly more, starting in Q1, where volumes are not necessarily going to be that much higher, and then continuing to escalate over time. But the important part of this chart is the trend that has been established already. These are all actuals. That's not my forecast. This is my forecast continuing and then accelerating that upward trajectory as Tesla becomes more profitable. How will Tesla become more profitable? I'm glad you asked. Well, we answered the first part in the previous video, which is that delivery volumes are going to increase. So that's good for your revenue and for your profitability as those revenues lever against fixed costs. But let's dive into this next tweet. Here's a chart showing where the average dollar of Tesla revenue comes from over time. So this is a forced 100% distribution scale for each quarter. So this is just saying for each quarter in Tesla's history and my forecast into the future, how many cents on every dollar of revenue, or on the average dollar of revenue, came from different divisions or products that Tesla sells. So overwhelmingly, we'll pick Q4 of 2021 as the most recent quarter of actuals. The money is coming from automotive sales, excluding regulatory credits. So this is the sales of vehicles. 82 cents on every dollar of Tesla revenue comes from there. So that's up a little from where it's been historically. This orange box says regulatory credit sales. What are these? Well, certain governments have stated that it's a priority for their citizens to have electric vehicles as opposed to polluting vehicles, and require automakers to sell a minimum number of electric vehicles, or a minimum percentage of their sales must be electric vehicles. And for any company that produces more than the government's mandate, they're allowed to trade credits with companies that did not produce enough electric vehicles to comply with laws that require them to. That's what regulatory credit sales are. So Tesla only produces electric vehicles and therefore has lots of extra regulatory credits available to sell to competitors who did not produce enough electric vehicles to comply with the law. So in 2020, a larger share of Tesla's revenue came from regulatory credits, but it was never more than 5 cents on every dollar. So 1/20th of Tesla's revenue was the most they ever made off of regulatory credit sales. But let me pause here and say, this is a perfectly legitimate revenue stream for your company that comes with almost no cost. And it's directly a result of producing vehicles. It's specifically producing electric vehicles more than needed to comply with the law. So if you can figure out how to produce a vehicle and then sell it once to the buyer and then sell it again to a competitor, I don't understand how that's a bad thing. And it's a level playing field. Anybody could have done that. Tesla was the beneficiary of that real world business dynamic because they saw an opportunity and exploited it the same as anyone else could have. All right, so that's regulatory credits. Going into the future, this will become a smaller and smaller fraction of Tesla's total revenues because those regulatory credits will become worth less as competitors make more of their own electric vehicles and as more competitors have EV credits that they can sell. It's a supply and demand situation. The rarer it is, the more it's worth. As fewer people need them and as more people have them, the price of regulatory credits will drop and Tesla's revenue from that revenue stream will drop as well, barring future legislation that increases those EV minimum standards. All right, I'll keep going to automotive leasing. So this is the revenue Tesla makes from people who are just borrowing a car, usually over a 3-year period, making payments and then giving that vehicle back to Tesla. Tesla is hoping that at the end of 3 years on that lease, they'll be able to either sell it for a tidy profit, or perhaps, if the FSD is ready, put it into the Tesla FSD robotaxi fleet. The energy segment here has been pretty steady at about 6 cents over time. I'm forecasting that to fall slightly over the next couple of years because Austin and Berlin will be producing so many more vehicles. Even though the energy revenue dollars will be growing, they'll still be shrinking as a percentage of the average dollar of revenue because so much more automotive revenue will be growing. Then services and other revenue I have pretty steady at around 6 or 7 cents going forward. All right, let's go to the next tweet and see a similar kind of chart that shows how Tesla spends each dollar of revenue on average. So I'll open this up and make it big. You only see red bars over here at the end of Q4 2018. I didn't mention that these are 12 trailing month averages. That's to smooth out seasonality and to make these bars show more consistent trends that wiggle less over time than you would if you looked at each quarter individually. So Q1 of 2019 wasn't a very good quarter for Tesla. Volumes were down that quarter. That was shipping Model 3 to Europe for the first time. After that quarter, there's been non-GAAP earnings every quarter since on a 12 trailing month basis. So how is Tesla spending its average dollar of revenue? Well, most of that money has been going to produce the vehicles. So the raw materials, the cost of transforming those raw materials into car parts or buying them from a supplier, the labor, the people who work at the factory producing the cars, et cetera. All of that goes into automotive cost of sales, the depreciation on the robots and the factory buildings, et cetera, go in here. Then the energy segment, these are the costs associated with power walls and power packs and mega packs and solar tiles and solar roof. Services and other, these are the costs at the service centers for doing repairs, those sorts of things. Then we get to the fixed costs. So we have research and development costs here, working on future products and product design. So that cost has fallen from 5 or 6 cents down to a pretty steady 4 cents. As revenues continue to grow, this cost is expected to decline as a percentage of revenue. So Tesla will be spending less than 4 cents on every dollar of revenue for research and development as time goes by, just due to the fact that the revenue will be growing by so much more, and you won't expect the R&D costs to increase by the same percentage that the revenue will be increasing by. Same's true for SG&A, excluding stock compensation. What's SG&A? Selling, general, and administrative costs. So you can think of these as the company headquarters costs, all the people who work in management for Tesla, the corporation, and all of the other costs that are not directly related to making the products that Tesla sells. So here you've got the everything else excluding stock comp. What's in here? If it's not R&D and if it's not SG&A, it's in here. And you can see in my detailed forecast further down what's included in these buckets. As time goes by, this number goes up a lot. Why is this growing when the others are shrinking? It's because the taxes on these profits. So the bigger these green bars of profit get, the bigger these gray bars are going to get as a result of having to pay the tax on the earnings. Let's talk about profits. So these profits are getting bigger over time as Tesla continues to lever revenue growth against more relatively fixed costs, and as automotive gross margins improve. So as these costs per dollar come down for automotive cost of sales, that leaves more profit. 14 cents is the actual non-GAAP earnings as a percent of revenue from Q4 of 2021. So this trend is not my forecast. This trend is real as reported by Tesla at ir.tesla.com. So I'm just expecting that trend to continue forward. And by the beginning of 2025, I'm expecting Tesla's non-GAAP earnings to be about twice as much per dollar of revenue as they were last quarter when it was an all-time record for profitability. So there's a lot to look forward to if you are a Tesla owner like me. Let's keep moving. This chart shows non-GAAP earnings per delivery. So the same green bar that we saw here is charted here all by itself. So here again, we see that there were losses at the end of 2018, beginning of 2019, on a trailing 12-month basis. And those have only grown over time. The note in the box that I put on this chart show that I'm forecasting an estimated $2 billion in deferred tax benefits from prior year's losses. So what's this about? Well, first I forecast it in Q4 2020 and it didn't happen. And then I forecast it in Q4 2021 and it didn't happen. So I have moved it to Q4 2022. So actually it's 1.6 billion in Q4 followed by 0.4 billion in Q1, the same thing that I had tried doing here. Tesla has not yet recognized this tax benefit. What is this? It's just if you are a new company, you're likely to lose money, to not be profitable for a while. It takes a while to scale up your business enough that you've got any money left over after paying for all your expenses, right? So the IRS isn't going to make you pay taxes on profit that you didn't make. And then as part of the tax code, you're allowed to roll forward those losses over time. And then the minute you become profitable, they don't expect you to start paying on taxes right away, federal income tax, federal corporate income tax on those profits. If you were losing money previously, you're allowed to net the losses against the profits, but the GAAP treatment is very strange on it. So they want you to wait until it's more likely than not that you will use all of the amount of losses that you've saved up over time, and then take a maximum of 80% of it in the first year, that becomes more likely than not. And then you're allowed to take the remaining 20% whenever you want, so long as it's not in the same fiscal year that you took the 80%. So time value of money being what it is, it's in your best interest to take the whole 80% that you're allowed to take maximum in the first year, and then that 20% as soon as possible, which is why I have it forecast that way. 1.6 billion here, 0.4 billion here, because it is a total $2 billion benefit at the income tax line of the P&L. You can find more information on that in the 10K if you want to read about it. Tesla has to say that it's that they're holding a deferred tax liability against the amount. Man, I'm going to lose everybody who doesn't care about accounting if I don't keep moving. So I'm going to do that right now. And if you want more information, Google it, look around on Twitter for it. I've done some tweets on it before. Let's keep going. So let's look at this same chart again, except excluding regulatory credits. So why would I do that? Well, because some people who hate Tesla or are otherwise vocal critics of Tesla got it into their minds back here in 2019 that Tesla would never be profitable if you were to subtract the regulatory credits revenue from the bottom line earnings. Well, that's not a valid thing. That's not a real metric. You'll never find that in an accounting textbook, because it doesn't make any sense to start with bottom line profit and then subtract from it the most profitable kind of revenue. That's not a thing. But if you did that back in 2019, Tesla was showing negative numbers for that made up metric. Well, since then, and the reason you don't hear people using this argument anymore, Tesla has been profitable even if you do that math. So even if you take the non-GAAP earnings per delivery and you exclude the regulatory credits, Tesla still has a positive and growing number. And look at the trend. These again are actuals from 2020 and 2021, growing to close to $7,000 per delivery of non-GAAP earnings. And I'm expecting that number to continue to grow over time. So what's doing this? Well, it's the volume of the deliveries increasing. It's the mix, because fewer of those vehicles will be produced in California, where costs are very high. There are not a lot of suppliers in California for Tesla to buy parts from, so those have to get shipped there. The cost of labor is very high. California has wacky labor laws in terms of compensation and benefits that result in higher labor costs than most places. So the costs of making more vehicles in China are lower per vehicle. The same is true for Texas. The same is true hopefully for Berlin. So that helps you. And as Tesla's software improves, as FSD gets better, more features, more reliable, better reviewed, more capable, more widespread, more buyers are going to opt for it. So your take rate is going to improve, which raises your revenue. There is no variable cost that comes with some buyer choosing to purchase FSD versus not. So all of that sale price drops to the bottom line as profit. And as that feature improves, Tesla can charge more for it. That price has gone up from $3,000 to $7,000 to $8,000 to $10,000 to $12,000. I'm seeing a trend here. It seems to me like Tesla is going to continue to raise the price of FSD as the software improves. And I'm forecasting that kind of rate growth and take rate growth to continue for FSD, again, with no accompanying cost. That's why these profits are going up by so much. All three of those things have a virtuous multiplicative factor that raises profit per vehicle. All right, let's move on to slide 10, and then we'll be done. So this is a chart I've never seen anybody else make. I like this chart for showing the relationship amongst beginning inventory, production, deliveries, and ending inventory. And I noted here, as Tesla's production moves to more continents, it becomes easier to manage delivery of quarterly production, leaving fewer days sales in ending inventory. So what does this chart show? Well, if you go back to 2018, you see these blue and purple beginning and ending inventory amounts were small. You know, these are not big, but as a percentage of the total, they were very large, right? So what's the orange? The orange is how many vehicles you produced. What's the green? The green is how many vehicles you delivered. So for each of these quarters, maybe I'll pick on 2021 Q3. This was the beginning finished goods inventory. How many vehicles did Tesla have parked in lots or on the back of car carriers moving toward being delivered at the end of Q1? What was the ending inventory for Q1? Well, whatever that number is, it's the beginning inventory for Q2. The violet number here becomes the blue number here. Then, so you've got that starting number of vehicles available to be delivered to customers. Then you've got this orange bar, which is how many new vehicles you produced during this quarter. The green bar is then telling you, okay, of this stacked bar, how many you had to start with, plus how many you made, that was your number of vehicles available to be sold. How many of them did you deliver is this green bar, and then whatever is left is your ending inventory. That has to be, or it should be, how many vehicles you have left at the end of that quarter, right? So what you see over time is these green and orange bars are getting much bigger without these blue and violet bars getting very much taller. And again, these are actuals from 2018 through 2021. So the ending inventory amounts are not climbing by a lot, but the production and the deliveries sure are. And I'm forecasting that there will be some growth in inventory counts at the end of every quarter as Tesla gets away from doing the wave of deliveries where they try to deliver as much as they possibly can by the end of each fiscal quarter. Hopefully, there will be less emphasis on that as production ramps at the new sites. All right, that's the end of this video. We made it to tweet number 10 in the thread. If you have enjoyed this video, then click the like button. If you haven't subscribed to my channel already and you would like to, there's a subscribe button there you can hit. And I will see you in the next video.